The Standard & Poor's 500 gained 4.7% in the third quarter, following the second quarter's 2.4% gain. So the index is up a total of 17.9% for the year through September 30th, and that's an exceptionally strong year to date, including dividends, which typically average about 3% per year on top of the price index. That would put the Standard & Poor's 500 up a total of 5.3% in the third quarter and almost 20% for the first 9 months of 2013. The stock market's strong performance thus far in 2013 has come as a big surprise to many who early in the year feared the negative consequences to the economy from the federal tax hike that became effective January 1st, and also the $85 billion cut in federal spending imposed by sequestration. So needless to say, the stock market has surmounted those worries and has moved far and away higher than the experts earlier in the year were expecting for years. Here you see the 5-year record of the S&P 500, and it shows that the stock market has been in a rally that began after the March 2009 financial crisis bear market bottom. Stocks peaked in 2008 and began a plunge that absolutely decimated portfolios. And in the throes of that crisis, as we all recall, some investors became convinced that the economy and the stock market might never recover, or would at a minimum take many years to recover. Unfortunately, for so many investors, they lost confidence in stocks and bailed out of the stock market, and I've run across many investors who still have been reticent to put cash back into the market. Classic investor behavior, which is so unfortunate for so many investors who simply are trying to save and invest for retirement. Earnings are such that stock price valuations are by no means stretched at all. So that if in fact we do realize $110 a share in S&P earnings this year and $123 a share in S&P 500 in earnings in 2014, which incidentally are the current bottom-up earnings forecast from the legion of analysts who follow all 500 companies in the S&P 500. It's impossible to say or predict with any certainty that, oh yes, of course, stock prices are going to be higher a year from now. On the other hand, it would make perfect sense for that to be the case if the economy doesn't fall out of bed, fall off the track somehow, and if in fact these earnings do materialize as is currently expected by the majority of analysts in Wall Street. The 5-year performance numbers show why diversification and rebalancing are so important to investors, because in any given 5-year period you'll have different types of leadership versus laggardship, and so it's so important to stay broadly diversified and periodically rebalance. Rebalancing is a mechanical means of systematically selling high and buying low. In other words, when you rebalance, even after a period like we've just seen, you might be taking something off of the top of small and mid-cap categories and redeploying that cash into large cap, taking something out of U.S. and redeploying into foreign. In other words, you're systematically taking away from the stuff that's worked and adding it to the stuff that hasn't worked on a relative basis, thereby systematically selling high and buying low. And that's the key to outperformance long term.